Alright, one welcome to today's analysis. So if this is the, should I call it day 2 of volume 2. So in case you have not watched the volume 1, make sure you go and watch it. So what are we doing? We said we are on a mission to analyze all the stocks in Nigerian Exchange Group, which is Nigerian Stock Exchange, NGX. Why are we doing that? We are trying to, we have in Nigerian market over 150 companies. Can you invest in all of them? No, just try to make it show. You should find a way to get to narrow the list so that you save yourself the time. So we have done that for you by using three filters. Filter number 1, we are not analyzing any company that its market cap is not up to 50 billion naira. Number 2, the stock must be liquid. That means the free floats of minimum of 20%. Then the company must also be making returns on the capital invested. So for the past 7 years or 5 years, the company should be able to be making returns. So we filter that. And finally, the company should have a free cash flow, not just manipulative earnings. So after we finish that, we are left with 29 companies. So after that, we started with that 29 companies. That's what we analyzed. So we have analyzed the first one being the first holdco. So after the analysis, we saw how their book was. So it is, if their book is good, then you take the next decision of doing your valuation, to know the worth of the business, you do your valuation to know the worth of the business, to know if the business is undervalued or overvalued. If it is, then you use your technical analysis and find the entry. That is just it. So doing this analysis only doesn't mean buy or sell or hold. It's to tell you, guys, their books are good. So you can go ahead with valuation and your technicals and stuff like that. So day 2 now is, we are looking at Dangote Sugar, which is, the ticker is DANGSUGAR. So this is their DANGSUGAR, this is their income statement from 2020 to 2024, which is 5 years. Why is 2025 not here? The 2025 result is not fully audited yet. When it is audited, we will include it. So we look at the 5 years horizon. Is a manufacturing company, so their books look different from the first bank book we analyzed, which was a bank business. So I'm trying to zoom too so that you will see very well. Because and if you are watching on your phone, try as much as possible to use landscape view so that you see the figures very well. So this is their balance. This is their income statement. After this, we look at their balance sheet. So for the income statements, what are you looking for? Whenever you open an income statement, you are trying to know, since the manufacturing business, you are trying to know if the business is profitable. If the business is profitable. So we have so many metrics you can use to check the profitability of the business. But since it's a manufacturing business, so the business determines the metric you are going to use. So since it's a manufacturing business, so we are going to look at the trade margins. We are going to look at their gross margin. We are going to look at their net income margin, and we are going to look at their operating margin. So that's the trade margins, and tell you the benchmark for such industry. So number 1, let's look at revenue. See what revenue is doing. The second item, we can see that these things are in billions. Take note, please. These things are in billions. You see that revenue started growing in 2020. The revenue was within the ambit of 214 billion plus. 2021, it grew to 276. This is 400. This is 400, and even in 2024, revenue grew to over 665 billion. So that means the business is selling and their revenue is growing. That's nice. Then, after the revenue, we are not here to teach you accounting. Then the next thing to look at is now the gross margin. So what is their gross margin like? So this is where we have done the gross margin percentage-wise. In 2024, the gross margin, 2020 was 25%. Then 2021 we have 18.19%. 2022 we have 22.81%. 2023, 19, and 2024 was the lowest. And you can easily track it with the expenses. So sometimes if the cost of expenses, remember they import a lot of sugar. So if the expenses becomes too much, it weighs on the gross margin. If the business expenses, direct business expenses, before you talk of the overhead, you are not here to teach you accounting, so but just know. So this is it. So, but how do you make a decision with this? So you don't just look at one item. One of the ways to do it is you can do the average. So the average for the past 5 years is 18 points. If you average this thing, it will give you 18.06%. So that has been, so you can say this is the average for the past 5 years. And the minimum for this type of business, because it's a low margin business due to the high cost of importation, they import a lot of sugar. So their margin is, if gross margin is over 10%, is a great business, is good for this type of business. There's a business that the margin needs to be 80%. We still get to that type of business. So it means from the gross margin point of view, this we take it good. Dangote Sugar has passed. So let's look at the next margin, which is the net operating margin. So the operating margin, this is it, 2022, this trend, 2020, 21, 22, 23, 24. So let's look at the average. If you look at the average, you see that it is 15.99%, and the average for this business, once it's up to 5%, it has passed. So net income margin, we give them good. So let's look at the last margin, which, operating margin. This is operating margin. They take good, they have passed it. Then the final test is the net income margin, which should not be 0. If it is 0, they failed. So provided, okay, so this is the net income margin. Provided the net income margin is not 0, then the business, so provided it's non-negative, it means they pass the test. So if they pass these 3 tests, you say that they have their income statement is profitable, then you move to the balance sheet. So, but unfortunately for the income statement, this is the average. We are having negative 2.0%. So what happened? You can now go back and look at 2020, it was 13% positive, 7.99, 13.58, minus 16, and minus. So this is the, so it was 2023 and 24 was the negative net income. So what happened? This was doing, because of the importing, so this is an outlier. When you are making your decision, so you have to know, not just because you saw negative, you now conclude, oh, it's not good. You can do the diggings if you are not in the market for a very long time. So what happened is that they took FX, they were double whammy, they were flawed, double whammy, because of FX devaluation in Nigeria. So it affected their bottom line. So that is it. So this is an outlier. So you can strip it out and do 3%. You can strip it out and do for the 3 years, which is above 11%. Because of this outlier. So sometimes if you find an outlier in a business, you can strip it out. So we are just teaching you the tricks now. So if you dig back into the books, if you zoom in here now, you can start seeing where they took that FX loss, which was again for some businesses. Look at it, unrealized FX. So this was it, 2023, 2024, due to they were impacted by the floating of the naira, and they are importation businesses. So that is it. So with this, give or take, we are giving them a pass. So the business is profitable. The business is profitable. It's a low margin business and it's profitable. So the next thing to look at is how is their balance sheet faring. So once you look at their balance sheet, then we draw the conclusion to know if you can go ahead and do valuations, do your technicals, and know even the real value of the business. It's just looking at the book. So for the balance sheet, so this is the balance sheet. You look at remember, we are not trying to turn you to an accountant. So we have gone straight to tell you the 4 metrics you can use to weigh this type of business balance sheet. The first thing is to look at their current ratio. If you look at the current ratio, the rule is if the current ratio shows how liquid the business is, how fast can the business meet up its short-term obligation. So if the average, like we said, you don't use just 1 year, you use average. So if the business, on the average, the rule is the current ratio should not be less than 1. At least 1 on 1 should be able to meet up your obligation. So for the past 5 years data, the average is 0.92. So it's below 1, which is the first red flag. The second ratio you can now go and look at is the amount of debt as against the equity of the business. And the rule is the debt should not exceed, the ratio, it should not exceed 1.2%. For this type of business, there are businesses that their debt level is 3% is okay. So it depends on the business. This is where analysis comes in, and this is where experience comes in. So let's see what theirs is. So for Dangote Sugar, it is 3% as against a minimum of 1.2%. So it means it's a highly leveraged business. They have a lot of debt. So we go back again, we look at another metric, which is debt to the assets. Okay, now let's weigh the amount of debt they have as against the asset the business have. The rule is this: if the debt is 60%, over 60% is a red flag. That means the business has more debt than the asset it has. So now let's look at it. Average for the past 5 years is 70.24. So also showing that it's a heavily debt financed business. Then the last metric we weigh before we now conclude on this balance sheet is the inventory. Remember, it's a manufacturing business, so the whole inventory. So we want to weigh in their asset part of the business, we want to weigh their inventory as against their current assets. We want to weigh their inventory as, so which part, how many portion of their inventory is current asset. That means it can show you if they are selling itself or their warehouse is stockpiled. So if it's over 60%, is not good. That means the warehouse is stockpiled. So we have 28%. So it's pretty good. That means they are selling, they are not holding a lot of inventory. So from these 4 metrics, the one they passed very well is they have a reasonable inventory structure. But from the liquidity side, we give them, they failed it. From the leverage side, they are highly leveraged, and from the financing side, they are heavy debt financed company. So summarily, in conclusion, looking at the 2 books, you can finally say that the business operationally is viable, but financing is very stressed. So operationally, they are making money. So if the free cash flow is coming in, which the free cash flow average for the past 3 years has been over 71 billion naira. That is free cash flow, which is pretty nice. So if it keeps coming in, the business can sustain. But the caveat is, whenever there is any macro shock, like you can have your FX devaluation that happened in 2023, you can have high interest. Once interest rate is high, it affects it because of the whole debt they are holding. Or if their cost spikes, if the cost of doing business spikes, it also affects you. So that is the caveat about this. See you in the next business volume 3. We do it to the 29. So tell us from this now, what decision did you draw and what the first bank owns to, and tell us what decision are you making with this. Are you going ahead with the valuation from here, or are you saying, hey, hold on guys, I'm not moving ahead from here? Till the next one. Remember to comment, share, subscribe, and reshare. Follow us on Twitter, very important also. Follow us on Twitter. The link is in the description. Till then, peace.